Welcome back to another episode of Palisade Radio. This is your host, Colin Cattell, and we are going to record this and try to get it out immediately because today was quite a down day for anybody invested in the resource sector. Nobody better to talk to today about it than David Morgan, returning guest, publisher of the Morgan Report. David, before I go any further, thanks for joining us on such short notice.
Well, my pleasure. I'm not running from anybody. I'm here to talk about it.
Well, good. Before I get started, I just wanted to say that the Morgan Report is one of the best resources that we rely on here at Palisade, and happy to call David a long-term friend and mentor on many things. Not very many people out there that can do both investing, which is what we try to do, and trading, which is something we would fail miserably at, but David seems to have the capability to do both of those, so I would definitely urge everybody to check out themorganreport.com. Now, with that aside, David, I do want to ask you, crash day in the commodities, if we want to call it that, certainly a brutal one. What happened today?
Well, it's very typical. As you know, Colin, I've been in this market really for 40 years, and I've actually noted at times on these really bad days, there's what I call a spike low. And I actually gave an update to my people a couple of days ago. Well, actually several. I do an update for our members get the monthly report, and then they also get, the premium members get a video that I do on an as-required basis. So in a real hot market, I'll do several, like maybe 3 or 4 in a month, and most of the time maybe a couple a month. So I told everybody when we broke the 1240 support for 2.5 years for gold, it was going lower, and I thought it could go below 1200. So obviously I'm right. Didn't want to be right, but that was the market was saying. The other part about the spike lows, you get this really big down day like we have right now in silver, where it's off 60 cents, and it's off 4% for the day. So if you looked at it on a chart, it's this big long line going down. There's a candle formation. I've been too far away from the candlesticks, so I don't use them much anymore. But so that's what I look for. In fact, a pretty prestigious magazine called Futures Magazine interviewed me years ago, and the title of the article is called Spiked. And I talked about spike lows and spike highs, and those are great entry and exit points. So I think we're probably going to see maybe a little more weakness. We could, but this is an opportunity for those that are willing to take advantage of it and have guts. It's really hard to pick a bottom, but this is typical behavior. I'll be watching it. It could go lower tomorrow. It could be higher. I don't know. But once a spike is in place, then you usually have a pretty safe place to get in the market.
What differentiates the action today from looking back? I don't remember if it was 5 years ago, I believe, when we had gold had a much more precipitous crash. Of course, you saw it go down about $100, and then it took a couple of years to recover it. I guess it doesn't feel like that, but this is still part of a bull market, David?
Yes, it is barely. Well, there's several ways to look at it. If you look at it from goldcharts.com, Bill Downey, and I used his graph and gave him credit. And I put on my Twitter feed. If you want to follow, just like Web 1.0, like all the articles I think are worth reading, just go to @SilverGuru22, my Twitter feed. You can read everything. And I put usually 2 or 3 or 4 things I think noteworthy. I mean, just no nonsense. This is stuff you should pay attention to. So coming back to Bill, he does an 89-month moving average. And that turns out to be $1,366 gold, US dollars. And it's actually brushed that twice and been turned down both times, with today obviously even more. So I thought it was a very interesting graph to put it up. So basically, if you're very conservative and you don't want to buy gold until you know we're back in a bull market, I'd use that number. I think it's a valid number. I was saying 1350 off the top of my head without, doing the charts in front of my people, which is, how I do it. And so there's no precise, there is a bit of art to this. But that's a long ways from where we are right now at 1175. I mean, if you're willing to buy here, at least a partial position, and hold on, by the time it hits, 1366, you've made almost $200. That's a lot to leave on the table. But you're also relieved of knowing if we're back in a bull market or not. So there's lots of ways to approach it. The problem I have, Colin, is I've looked at all this stuff for so long, and I've made my own determination of what works for me and my personality, and that's what I teach everybody that subscribes. But, I know these other methods that do work, but people don't stay consistent. You need to pick a plan and stick with it. And I made all those errors. As a young man, it was this and that, and this indicator was better than that indicator, and then I tried different formula. And you just got to settle down, get with the program, and keep it very simple, which is what I do. I hardly look at any of the indicators anymore. I just look at basically a different way of looking at the market. I draw the lines, and I look at volume. And then I have what I call the Morgan rule, and it's got to the market has to tell me what it's doing, and it has to verify it by a certain number of days and a certain amount of volume. And if that's the case, then we win about 85% of the time. And it's pretty simple. In fact, I've had people that are like, oh, come on, it can't be that easy. It's like, you haven't been here 40 years. I have. Trust me. And of course, they start going, holy smokes, this is great. So anyway, enough about me and how I trade. I think the more important part is maybe the fundamentals, Cole, and maybe I'll flip it and ask you, have you given up on gold? Have you given up on silver? Have you given up on the research sector? Why would someone your age that has all kinds of opportunities in front of them say, hey, I still want to be in the sector?
Well, I think that goes back, David, to finding a sector that is cheap right now and that I understand, and that's the resource sector. So today made it a bit more difficult at times, but the deep value is there, and there's still places to make money in this market. So it's certainly a no-brainer from this side. I guess listening to you and your indicator, plus or minus a few percent move here, do you feel that the bottom is in for gold and silver in these stocks after today?
Well, I bought silver a couple of days ago. I bought some of the miners yesterday, and I loaded up today. So I think that kind of speaks for itself. Do I have cash on the sidelines? Yes, I do. It's another lesson learned. It's always like, oh, this is it or whatever. And I played that game too many times and been burned. So I do have some cash available. And let's say we got another 62 cents down tomorrow, which I really doubt, but let's say we did, I would have cash available. So, most people filter in and out. In fact, in the book Second Chance that David Smith and I wrote, there's several techniques that you can employ. But again, you just really want to pick one that suits you, your personality, and, what the market's doing. I could kind of shift horses, so to speak, and employ different techniques within my main technique, if that makes any sense, Colin. But it does, it comes from experience more than anything else.
Thinking back to that first move that we had in this, what we're calling bull market still, January of 2016, it was quick, it was furious. People made a lot of money very quick if they were involved, and people piled in very quick. Is that going to be what you think we will see when we do eventually start to move back up, or do you expect something more gradual, longer term for this next leg?
I expect more gradual, longer term. I know most of my compatriots think that it's going to be up and away. I do believe that will happen at the end, like you see in all these markets. It's very typical for the real estate market or the dot-com bubble or even a bond bubble to really accelerate the last few months. And I do expect that in metals, but I think we're going to have to grind forward. I just did an update for free called something about Bitcoin. And I just choose Bitcoin because there's so many newbie investors in there. And I explain how markets move and what overhead resistance means. And for the radio, it's a little bit hard to do. But, if you bought silver at $20 a few years back, let's say in 2016, I think it had a high of 21, if I recall correctly. And, you thought 20 looks good, it's safe, it's going up, and it made another buck move, I think, up. And you held all the way till now, and now you're looking at, $14.50. When it gets back to 20, your wife might be on your back. Why'd you ever buy silver? I don't like it. I told you not to, blah, 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 blah. And it gets back to 20, and that guy sells at 20. And he broke even. So psychologically, he feels a lot better because he didn't lose any money. He had to hold for a long time. He didn't like it the whole time it was down, but now he's broken even. He feels great. That's called overhead resistance. So there's a lot of overhead resistance that has to be overcome in both the silver and gold market. The problem is they're such small markets, or the advantage, I should say, is they're such small markets, Colin, as you know as well as me. I mean, you grew up knowing this stuff because I know your dad and all the stuff he's done over the years, and I know you knew this from a very early age. They're such small markets, and gold is the most negatively correlated to the stock market that you could blow by that overhead resistance. It could move so fast that for going back to that $20 example, and I don't think this is what's going to happen, I want to be clear, but it could. that you go zoom, zoom, zoom all the way. You're up to 18 again in a matter of 2 weeks, and then you're at 19 in a matter of a month, and then a month after that you're back to 20. Well, those people seeing that kind of move on the upside are more likely to hold on and wait, see what's going to happen. So it can go both ways, but the small market that it is, once it starts to go, there's so much money in the stock and bond market that would be feeding or finding something that they really want and can trust when they distrust the stock and bond market finally. I mean, that window is, it's Doug Casey, and there's so many analogies, but it's like trying to put a fire hose through a garden hose. It can't be done.
Yeah, understood. Well, David, when we fast forward, say 3 or 4 years from now, and we look back at a chart, you understand this stuff better than me, but if the HUI holds around where it is now and gold holds around where it is, are we going to see this as a double bottom, something that you could almost compare to what happened in 1998, 99, and then again 2000, 2001, where things moved up and then bottomed back before taking off?
I doubt it. I think it'll be close to a double bottom. I just looked at the chart before our call, and we were under 14 in 2015. Was the low finally for the silver market and the gold market. I don't think we're going to revisit those, but we could. I don't ever, I get beat up by my calls, but people don't subscribe, so they don't know, kind of. If I change my opinion like next week because the chart showed me something different, or the market, I should say, showed me something different, I would, tell everybody that's paying me. But if I don't interview you for another, 6 months, then they're going to say, well, you're going to be calling, and this is what you said. Yeah, that's what I said that day. But markets change, and if I can't change as much as the markets change, then who am I to be, somebody in the market? So I have to be nimble. I have to be adept. I have to be able to, make a move and a counter move. So no, I don't think we'll double bottom. I mean, looking at a chart and you squint, it would look like a double bottom even here, but I don't think you're going to test those lows. There's too much sentiment that's anti-metals right now. I have a guy that's older than me. It's really good. And he just sent me a note. He basically apologized. He goes, David, I hate to do it, but I'm out of the gold market. And here's why. And I read his stuff. He does really good work. And he basically said, I don't do it based on opinion. I do it on my research and fact. The fact is we broke this level on gold. Therefore, I have to sell gold. And I don't blame him for that. I like someone that's consistent, and that's the way he's looking at the market. I would not ever short this market at these levels. No way.
All right. Well, let's finish off with a more fundamental review. Gold and silver are not the only metals down today. I believe palladium was down 5%, copper, zinc down 2-3%. So a lot of those gains that were starting to show the strength of a sustained market, not just in the PMs, but across all the commodities, are starting to be given up. And that begs the question, how much time is it going to take for things to kind of reform and start moving back up? Are you worried on the fundamental side on demand?
Yeah, I've said something in the past. I'm going to revisit it. I mean, I can look wrong. I can look right and then wrong and then right again. And I know that might sound silly, but I have the idea that this next big move up isn't going to be a commodities move like we saw in the early 2000s, when China was buying everything under the sun to build out their infrastructure and just build out that whole nation state. I don't think we're going to see a major commodities boom. That's why I'm not that bullish on copper. I'm bullish on some of the base metals. I mean, we made our call on zinc. We were right on. We bought and sold our top position in zinc and doubled our money, and we're happy with that. We haven't touched zinc since. The point I'm making is I think, Colin, that we're going to see a bifurcation, which means gold and silver, maybe platinum, palladium, but mostly gold and silver will be going north in the commodity sector, except for the ags, when that's another story because of the food problems, are going to be going higher and higher. And you're not going to see many of the other commodities in the commodity index going higher. So I think you're going to see a bull market in gold, silver, oil, and the agriculturals. I don't think you're going to see it across the whole commodity sector, which includes the base metals. There'll be the elementals, the lithiums and the cobalts and the vanadiums and the this and the that's that are extremely small markets that will get their big, pops up and down kind of thing. But for the real trends, it's going to be a run to safety. It's going to be a run to basically what we trust, and that's going to be gold in the final innings. But until then, it's going to be a run to the dollar. So to see the dollar going up and gold going down at this point in time is upsetting on a short-term basis. But on a long-term basis, it goes perfectly well with what I really brought out to the fore before anyone else, and that was the Exeter Pyramid. John Exeter, a ex-Federal Reserve banker out of the New York Bank, provided a liquidity pyramid, and it shows what happens when there is a flight to safety.
Well, David, thank you again for coming on at such short notice. David's the publisher of The Morgan Report, can be found at themorganreport.com. And hopefully next time we get you on, which if past is prologue will be in just a few months here, then we'll be talking in more positive light.
Excellent, Colin. I always appreciate speaking with you. You're one of my favorite younger guys, and I take that as a compliment. I just really appreciate how fast you've come on board. Of course, you had a good tutor, your dad, and you've done a lot in the space, and it was great to see you in Acapulco. I hope to see you down there again this year, or I should say, next year, 2019.
Absolutely. Well, thanks so much. Appreciate that, David.
Okay, take care.
Think you understand the junior mining sector, and you think that the participants in the mining sector, junior mining sector, are good people and kind people, hit the bid.
How violent that term could be, it actually could be quite violent. It could be a rip your face off uranium rally.
And the world is always going to need raw materials. It's going to need copper and gold and nickel and so forth.
Totally destabilized. Hey, Troll, did you hear what's going on in Yemen?